Hello, everyone, and welcome to the Cash Rules Podcast. My name is Keith Smith, and I'm here with my co-host.
Yo, everybody. Fabyan Roldan. Welcome.
He's the head of research. He's an educational program development specialist. And today we're actually here with our special guest. We have David Mullings. I want to start off just by making sure, everyone, that we are clear that none of what we're discussing today should be taken as legal, financial, or tax advice. Instead, the objective of our conversation today is to really highlight some of the unspoken rules in finance, discuss why these concepts so often go unspoken, and what we can be doing on a practical level to change that reality in an informational, educational capacity. With that said, Fabyan, how are you doing today?
I'm feeling great, man. Oh my gosh. I feel like, I think I might have woke up and played lotto. I feel like I'm about to hit it today. How you doing?
I'm absolutely incredible. And most importantly, I'd love to know, David, how are you?
Man, I need Fabyan to send some of that energy over here, man. I love that. It's infectious.
I love it, man. I do appreciate you being here as well. I know our viewers are going to love it. You're going to provide us with so much information. Let's get it cracking.
Yeah, man. So David, please just start off by telling us a little bit about yourself. Briefly, what's your background? Where are you based? And what are you doing on a day-to-day basis right now?
Yeah, so based here in Florida, based between Orlando. I spent a lot of time in Miami. Born and raised in Jamaica. I went to University of Miami. Did my MBA there as well. Focused on market and international business. Was an entrepreneur. Launched a business during that time, a tech company with my brother. Eventually worked in finance in Jamaica, and then moved back to the US. Worked in low middle market private equity. Worked with a black-owned long bias hedge fund, and now launched my own investment firm, Blue Capital, which is focused on mainly investing in the Caribbean. We want to give investors access to overlooked opportunities. And that's really where we are. And we're excited about what we're working on now.
Very cool. And so to dive in, I just want to start off by picking your brain about being raised in Jamaica. Talk to us a little bit about what the financial world looks like in Jamaica relative to what you saw when you came to America. Was it something that was on your radar? Were you learning about anything around finance in school there? Tell us a little bit about that.
We learned the basics of finance in school, but at the same time, my parents, dad is a doctor, mom is a nurse, but they had investments. And so they had us get to actually sit in meetings, which I found out was rare, but we would get to sit in meetings when they would come to the US and check on their portfolio. Back in the day, this was Solomon Smith Barney, which doesn't exist anymore. And so, that was a frequent topic to learn about those things. Dad came from an entrepreneurial family. His mom ran her own store. His dad worked in insurance. So it also worked out that my parents pushed us to think about entrepreneurship. So since I was 15 years old, I had my brother and I present every summer, every Christmas pitch for them to consider investing $10,000 into a business. They said no for 5 years, but the point is we had to go through these 5-year projections and make that pitch. And I think that was something that was crucial in getting us to think about finance. And then we have some other, we consider family members who are in that space. That's how I got into private equity. They had been an entrepreneur and then eventually launched their own private equity firm and really took me under their wing and had me study Warren Buffett and read every book that their mentor would share with them. And then every 3 months we'd meet up and discuss the books, we'd read articles, we'd read annual reports. So it was something that didn't come naturally. It was something that my network, the people around me, brought to the table on the finance side. And in Jamaica, it's different, right? We see people who look like us, who have money and have done well, but at the same time, it tends to be even more elite compared to the US. And we don't have access to the same investment opportunities in the Caribbean as we have here in the US. So when you see the land of opportunity, it really is. I don't think Americans understand how much better they have it from an option standpoint.
I want to dive into this concept of private equity really quickly, just for our viewers who don't know what that is. Mm-hmm. What is that?
So private equity is interesting how we think. In general, private equity is investing in private business. Private equity, most people think of PE as only leveraged buyouts. So you think of companies like Blackstone and so on. But private equity covers venture capital. It could cover real estate. It's investing in private assets that are not traded. But what I specifically worked in was investing in companies. So when we think of private equity, we separate that from hedge funds. Hedge funds tend to invest in public markets. Some have done other things, but they typically do public markets. And then, of course, you would separate your real estate fund out from private equity, and venture capital technically is a subset of private equity. Yeah, so that's what private equity is, though, and typically is a fund structure. So that's what we mean when we talk about private equity. You raise capital into a fund, and then you deploy that money over time into various businesses with the intention of growing that capital.
Very cool. Thank you for that. And then, do you have any kids?
Yes, so married now, and wow, yeah, married for 15 years and married to a Jamaican, and we have 3 children, 10, 9, and 4, 2 boys and a little girl.
Okay.
Yeah.
And I wanted to ask you that because I wanted to see if maybe you felt like you've noticed any differences around maybe like what they're seeing in school around finance and money growing up, and if you had a different experience in Jamaica.
I don't think they've seen anything different at this age either. I mean, we certainly have, especially me, I put a lot of effort into them learning. So, when our oldest son turned 5.5, just after 5, he lost his first tooth, and we had him get money from the tooth fairy, and we had him invest that money. I mean, we literally, since that age, I've had them talking about Warren Buffett and open a little account online. And then eventually they actually check on that portfolio quarterly. They help to pick the companies that get put into their portfolio as well. So I have taken the time to do that. And we spent time, we play a lot of Monopoly, I'll be very honest. So they got to learn about money. And, once they started doing, for example, addition and subtraction, we use money to help them think about it. We bought this little toy cash register. The kids have a little toy credit card, and they'll set up a store. Just the other day, 2 weeks ago, they had me. They drafted a menu and had me order pizza and popcorn, right? And I had to give me play money. I had to pay, and then they had to give me change. And I think it was a great way for them to learn to count to the addition and subtraction, but remind them of the value of money.
I think that's a great segue into my question, which would definitely be, what are some of the concepts about building wealth that you've learned in your career that you're sharing with your kids and others?
Man, so one of the key ones that I try to impress on them, because I actually didn't learn this concept until my MBA, which was surprising, but is the time value of money I think is the single most important thing. A lot of people think, okay, $1,000, I put out $1,000 today, I get back $1,000 in a year. I still got back my $1,000. Yeah, well, time has passed, so the $1,000 doesn't buy the same stuff in a year's time. So we need to understand the time value of money, which also means that you need to understand the money value of your time. That's something else that we tend not to be taught as kids, right? When we say time is money, I don't think enough people really take that seriously. So yes, you fill a day with meetings. Are those meetings productive and benefiting you from a financial standpoint? Is it that you're gaining information? So time value of money is the first one, and the most important concept that I think we should be focused on even more. And then the second one is compounding, right? Compound interest. Einstein said that compounding is the 8th wonder of the world, and he was talking about compound interest. Most of us learn simple interest in school, right? $1,000 times 10% means you're going to get, $100 in interest. Yeah, but what if you left it in there and it compounded the next year and the next year? Not enough time is spent on getting us to understand compounding. I don't think the human brain naturally understands how compound interest works. And whenever I do a presentation of financial literacy, I have this, 2 options. I put up this picture with a penny and say, if you get 1 penny a day for the next year versus just take, $2,000 today, which one would you take? And most people want the money today versus not realizing if the penny doubles or compounding, how much more it would be. So I think compound interest is critical. Time value of money and the power of compounding are the 2 most important topics that we need to understand. And then lastly is debt, the difference between good debt and bad debt. I think that unfortunately too many people think all debt is bad, and that is not the way we need to think about it. If you can borrow at 5% and get a 10% return on that money, that's good. That's good debt, right? A mortgage in most cases is good debt, but we need to understand the difference between good and bad debt.
I love that.
So I want to dive into at least one thing that you said, which was around how $1,000 today isn't the same thing as $1,000 tomorrow.
Mhm.
Talk to us about how and why that is the case.
Well, so now we get into more on the economic side, right? We think that now everybody knows about inflation at this point in time. We understand that's been talked about.
Or at least feeling it, right?
At least we're feeling it, right? Exactly. I mean, like the bread I used to buy 2 months ago costs more today. Exactly. So, what used to cost $5 doesn't, $5 doesn't get you the same thing anymore. And
No.
it was fascinating in undergrad when I did an economics class. They had this thing called the Big Mac Index, and this is real. This is Big Mac from McDonald's. Allows you to look at the price of Big Macs across the world, and it gives you an idea of the purchasing power of each economy. So I can compare in relative terms the strength or weakness of an economy, and you can see over time. I never forgot the Bank of Jamaica actually used this one. I talked about this for years. I wrote a column in the newspaper. I called it my patty index. So I'd go to Jamaica, I'd buy my beef patty and eat it, and I'd track the price over months and years, and you'd see the price would match the dollar devaluing, the Jamaican dollar going down. The same thing is happening everywhere in the world now. If you leave your money in the bank and you're only earning 0.5% interest, but interest rates are 4%, you're losing money, right? If you are not staying at the same level, then it means that you can't buy the same things in 1 year, in 5 years, or unfortunately when you retire. And that's something that we have not thought about enough. We think that, I saved $1,000. It can't buy the same thing. And we've seen that happen with house prices, right? What our parents could buy, 30 years ago, there's no way we could buy that. What you could rent in college, you can't rent today. And that is the concept, is inflation. Things go up in cost. That's just the way it is.
And so talk to us a little bit about what do you do in an environment like that, especially today over the past couple of years in America alone, which obviously has a global impact. We've seen the monetary base go up about 30%.
Yep.
Right. Well, so we don't control the Fed, obviously. What you have to focus on is your returns. So if you are sitting on a savings account that's getting you 0.5% interest, I assume that's your emergency fund. That's not the one that you're investing to try and stay at least even, right? If inflation is 4%, then you're only getting 0.5, you're going backwards. So it's important that you focus on finding opportunities to invest your capital. Ideally, you want as low risk as possible, but as we know, risk and reward are inversely related. So the higher the potential return is usually the higher risk. So you need to have some capital you're setting aside to take some risk with, but you have to care about interest rates. You have to pay attention to the interest rates you pay with your credit cards, for example. A lot of people don't pay attention enough to their credit card interest rate, and they're not looking to refinance or your mortgage if you have one. Focus on getting the lowest rate possible and pay it off. If your credit card interest rate is 15% and you pay down that card, immediately save 15% right there. That's a hefty return that a lot of people aren't thinking about. You can use a card, and guess what? You're probably getting points and get some additional benefits. But pay attention to the interest rate you are getting, and pay attention to the interest rate that you're paid, and look at the difference.
Yeah, I do think that's super important. And I want to backpedal a little bit because, one of the effects of, you mentioned risk, right? And trying to manage your risk as well. One of the effects of having a monetary base sort of inflate at such a rapid pace is that you almost actually, in a sense, what we saw as a reaction in stocks, equity markets, public markets, is that you actually were forced. Some people were forced to take more risk. And so what companies did was they bought their own stocks. Investors started pouring money into the stock market, and we reached new highs in a time where some thought that we were having an economic contraction. My real question, I guess, is on a practical level, I am graduating from high school or college, and I want to protect my earnings as I go out and get my first job or whatever. What should I be doing?
Well, of course, everybody's different when it comes to their time horizon. I'm a long-term investor, and I think especially if you're young, you need to be thinking 30 years out, right? You're not here thinking 6 months from now or even 5 years from now. You're building a portfolio over time. So you're not looking at the market movements today. What you want to do is build healthy financial habits, mainly dollar cost averaging. So you don't just take lump sum money and put in one time and then not invest for the rest of the year. Every month, you should just set aside some money and put it into the market. And this way, you are not trying to time the market. Most people cannot time the market, and you shouldn't try to do it. So whether the market is up or down, you should be buying. You go in, and that way it smooths out your average purchase price. That's what you need to care about. I don't think enough people think about that. So if I decide every month after my first job, I put in $100 into my, whether it's my Robinhood account or whatever it is, and I'm buying preferably a basket of stocks. Picking individual companies is typically a lot of work. I think it's better for you to go and buy a few ETFs, for example, and let somebody else who's a professional manager who has time to check on the companies and manage a portfolio.
Makes sense.
Let them do that. But you just have your specific stuff that you buy, and you just consistently every month keep putting in that money. And then over 5 years, you're going to see it compound, right? On average, the market isn't going to crash and be down for 5 years. It's not going to be down for 10 years. I mean, it's interesting the time that you get in. If you do not do any more, then yes, you're going to have a problem. But if you're dollar cost averaging, you will work out quite fine. So that's a term I want all your listeners to go and Google: dollar cost averaging.
Very good. Very good. Thank you so much for that. One of the things is, I think as young investors, we see all of the big memes, and we've seen also a lot of volatility over the past few years. And I think it's a very, what's important is understanding how psychological, right, investing can be when you're trying to pick bottoms and tops, right? So let's say I want to invest my $100 in the month, but I want to time it. Okay, so I'm going to wait until something comes down 10%. I'm going to put in my $100 and then maybe it falls even lower, right? So, okay, well, now I could have saved some of what I had and just put it in lower. Oh, let's say you put in that $100 and then something went 10% higher. Oh, well, you should have put in more at that moment, right? So it's like basically getting rid of sort of those biases that we have, recency biases around, what's happening in real time. You step back, you set a date, you set an amount, and no matter what happens, you're continuously getting something.
And so, yeah, and that gets to the point of, something that I think is crucial. It's 3 rules of outside success that I learned from my coach, right? We don't use the term mentor for him. Billionaire Jamaican Canadian Michael Leach. And Mike says that the 3 things you need is: number 1, you need a framework. Number 2, you need control of emotions. And then number 3, you need access. So access to investment is fairly easy for us now, at least public market investments. Framework is you decide, am I going to be a trader? Am I a long-term investor like a Warren Buffett? You get to choose your framework. And typically you read and learn about somebody and you're following their framework. But control of emotions is critical. Right? There are so many people who will invest now, it goes down, they get upset, they pull the money. Well, you've just locked in the loss versus sticking to your framework and controlling the emotions. Or you put it, and as you say, it jumps. Oh man, I should throw some more. Let me do extra. Let me break my rule and do something more. Every time I've had mistakes in life is when I've broken my rules, right? I've moved outside of the framework because I got excited. My emotions got the best of me. Oh, this can't fail. This person has a track record of success. I have to go and do this. Guess what? That's the one time it didn't work. So control of emotions is the single most important part of investing, whether in public markets or you're going to do real estate or you could be buying Air Jordans. You need to control your emotions and separate that from investing. Yeah.
I wanted to ask you, when you first started, how were you given these resources? How did you find them?
Right. Well, yeah, thankfully, the internet is our friend. So, saw an article about, for example, I read about Warren Buffett, and he doesn't talk as much, but there are books and he writes. He writes a really good letter every single year in his annual report, and it's free. You can go on berkshirehathaway.com, go to annual reports, and then read what Warren Buffett shares. And he shares some really good down-to-earth information about investing. So I read books. I mean, I would go in Barnes and Noble, and as a college student, I couldn't just buy a ton of books. I would sit there. I would start reading the book. I would take a picture of the page that I stopped and I'd leave, and I'd come back another day and continue reading the book. Let's be honest, we need to save money, right? Cash rules, cash matters. So, eventually you'll buy the book, fair enough. But there's so much knowledge that's hidden in those books. If you go to that business and investment section in a Barnes and Noble or your library, you will be very surprised what is there. And then, of course, I would say Warren Buffett's shareholder letters are amazing to read. Very down to earth, very easy to understand.
Love that. I think it's super important to really read. There's certain information that just doesn't exist in other formats, is what I've learned. There's in a world where there's like unlimited new options, where like you can now go into the metaverse, right, and spend your time maybe discovering something. It's like you still have to realize that the packaging of information that is in a readable format is typically one of the most potent formats of really getting knowledge around whatever it is you want to learn. So
right. And thankfully nowadays we also have podcasts that we can all go and dive into as well. So I think reading and no podcasts as well put together allows you to learn more. I mean, there are podcasts that are interviewing people who literally do investing for a living and have been very successful. Study successful people. Let's just start with that. If I wanted to become a really good basketball player, I'm going to go and study Michael Jordan and Kobe and so on, right? Or whichever position I'm going to play. I'm going to study those people. I'm not trying to repeat exactly what they did, but I want to understand what did they do to get to that position, and what they accomplished. I want to understand, how mentally they worked on it. It's not just a physical skill. They take a certain mindset to what they're doing as well. So I want to understand that. And then I want to be able to find the things that are repeatable.
Yes.
Find role models, right? What Michael Leachin would say, find a role model, get the recipe, don't change the recipe. You're only allowed to change the recipe when you exceed your role model. His role model is Warren Buffett. Well, Mike is now worth over $2 billion. So clearly the framework has worked for him.
I'm glad you talked about mindset, right?
Mm-hmm.
And as we know, a mindset of any young or new investor, there's always the pessimistic mindset of losing money, risk, and etc. What is the riskiest move that you've made with your portfolio, and how did you justify it? Like, where did it go wrong? Where did it go right?
So for me, I like that. I was going to say it's a trick question, but I have a trick answer. So the riskiest move I've made with the portfolio was actually this year. Back in February, I liquidated my entire personal portfolio because Bloomerhole Capital had an anchor investor fall through, and I needed to put money. This is my business. I founded it. And so I had to put personal capital into the company to make sure that we could scale and continue on our path. So I liquidated the portfolio. That's a very risky move, right? Pretty sure that even if it goes down, it's still there. Move it from a public investment into my private company. So that's risky. I don't know if it has worked out right or wrong as yet. But in my case, certainly, what happens though is that it so happens the market went down after that. So it for me, certainly, I ended up having more cash to put into the business than if I'd waited 1 month or 2 months. So I wasn't trying to time the market. So I haven't felt the pain everybody else has felt in this market going down, and looking at the portfolio. It's like, oh man, I'm down 30%, I'm down 40%. Yeah, I'm not down at all. I took it out. But it wasn't because I was smart. However, I do think the best investment you can make is in yourself. Right? I have more control over where this goes, where the business goes, and what can happen. So that currently is the riskiest move that I have certainly made. In the past, I would say the riskiest move that we made was that we did a real estate investment many years ago. Our family, we all of us put some money. We bought some raw land here in Florida, and we had never done that before. Right? Typically, you want to buy income producing properties. That's what everybody talks about. You buy that duplex or the apartment or the house. And this was just raw land, and mom and dad literally had taken a map, and they looked at, where's Walmart being built? Where's a McDonald's coming within 30 miles of an airport? Identified some property, bought some lots. We paid $5,000 for each lot. And a year and a half later, we sold each lot for $25,000. So
this was raw land.
Raw land, which is the easiest thing to keep, right? There's no big upkeep costs. I don't have a property manager. I don't have anybody renting it and worrying about evicting them or damaging it. So
the most you're paying is taxes, right? That's
the most you pay is the property taxes every year, which is
right.
Undeveloped land. So your taxes are even low. So it was crazy. Yeah, $5,000 turned into 25K in less than 2 years. So that was an unbelievable opportunity. That was a big risk that we took. It was our first time, and it worked out very well for everybody.
That is
Nice.
awesome. T, if you want to go ahead, or
Yeah, I mean, I was just going to move on to one of the last questions, one of the wrap-up questions. Tell us, what is something that you think is the most important aspect of personal finance that no one actually ever really talks about? You've given us some good gems, but maybe something that isn't too common. I think we've talked about a lot of cool stuff, though.
Well, I'm going to repeat control of emotions. And I think that is so important because certainly I'm one of those people. Most of us humans, we can justify any expenditure. We can convince ourselves that, well, I bought this because it's going to allow me to do X, Y, and Z, or it's going to open the door to this. So we can justify every single dollar that we've spent. And in most cases, we shouldn't be justifying it, right? We spend that dollar because we got caught up in the moment. Oh, that looked really good, and so I bought it. And what I've learned to do is, if I see something that I really like, wait 24 hours before actually clicking buy on Amazon or, swiping the debit card or credit card at the store. Wait 24 hours. If I still want it in 24 hours, then I think that it's going to be reasonable. But in most cases, you end up not buying, right? So deferring self-gratification, right? Control of emotions is the single most important thing that you can do when it comes to personal finance.
It reminds me of like when you have a young child and they're trying to get a tattoo or pierce their ears, and you're like, all right, wait 6 months. Right?
Thankfully, I haven't reached that point as yet. So we'll see. I remember it was funny when I was young. I wanted a bike. I wanted a Yamaha R6. My brother and I negotiated with Dad and said, hey, if we do really well in college, that's what I want as a present. And we got the financing in place. We had all the paperwork, and we came home. And Mom saw the paperwork, and she just said, if you buy this, you're not coming back into this house. And which I tried to understand why. And she said, well, I'm a nurse. I've worked in emergency rooms. Have you done research on, what the potential results are from a crash, the risks of a crash on a bike? And I said, yes, I would, but I don't want to be a quadriplegic or a paraplegic. I would rather just not be here. Like I play too many sports to have that. And so, because of Mom, she stepped in, right? Like that tattoo, and just said, well, she didn't even say wait 6 months. She just said, okay, if you buy it, you can move out. It's as simple as that, and go from there. But you have to have, again, I was going to justify it. Right? Oh, I did well. I deserve this thing. I wait a little. Just wait, take a break, breathe, wait 24 hours or more, and then go from there. And sometimes you need an outside person to be that angel that says, hey, just pause. I know you want to go and buy this property, or you want to make this investment. 1 second. Just wait.
I think that's genius, actually, right? Like having some accountability partner around how you make your investment decisions could be a really big deal too.
Yep. And that's why investment clubs can be beneficial. But yeah, having an accountability partner. I mean, I try to explain to people when they come to me and say, hey, Blue Maho Capital, David, I want to meet with you. I want you to look at investing in this thing. And I said, good. The most important question you should ask is, what's the process for us to determine an investment? It's not just me. There is going to be an investment committee, and I'm only one of the votes. We are going to have a discussion, and that way you have accountability. In most cases, it's never one person that makes that decision. And usually if it's one person making an investment decision for their money, they're going to make some big mistakes because they're taking big swings. They have their own biases. So have somebody else to just check yourself.
I love that you said that, because I actually oversee. I'm the president of my own investment club, GTF Investment Clubs. And when a group of my friends and I first started doing investing, we were just doing study groups, just sitting down. And this is probably just before COVID had started. The investment club is only about 2 years old now. In actuality, we didn't know what we were doing. And everything that we've read up on said that investment clubs were not the best thing to do. So it's quite interesting that you're saying now, based on accountability, investment clubs might be the best thing. I mean, I find it to be awesome because it gives you critical thinking in terms of one topic. Certain things you're not looking at it in that lens, that now somebody else is there to now tell you hey, listen, I'm looking at it this way. You now realizing like, oh wow, maybe this is not a good investment.
Yeah,
So I
exactly.
do like
And
that.
we all have different experiences. So why not? I'm not saying everybody should pool their money in investment club. That's different. Yeah, that's fine.
Right.
But at least pool knowledge.
Right.
There's
At least.
nothing. I mean, let's think about it. Blackstone, all these successful investment companies haven't gotten there with one person. They've pooled the knowledge. They've hired other people and said, guess what, guys? We're looking at this. Give me your analysis. Give me your feedback. I mean, we have some deals that we're looking at recently. We got their financials. We have an investment analyst on our team. We sent the info to the analyst, but we also have someone that's on our accounting side. I had our accounting team member also look at it, and both of them had different questions from the same set of numbers and different insights about the company from the same set of numbers. So I could go back to the CEO and say, hey, so here's the questions now that I have. Not just my questions, right? I'm more on the business side, but here's some other questions related to finance. And it was a good reminder for me that I want to involve more people in my circle when we are doing analysis on an investment opportunity.
I love it. I love it. I think I had just one. Go ahead, please. Go ahead.
And I was going to say, and don't ever assume that somebody, and this is a mistake I made with my wife is a teacher, K-12 teacher. And so I never used to talk to her about business and investment stuff. And one day it came up and she came up with an idea and I was like, holy crap, the non-MBA person came up with the best idea in the room. Don't assume that just because somebody is not from a business background or investing background, don't assume that they can't provide insight into what you're looking at. Never assume that.
I agree with you 1,000%. 4 years ago, I had a young man. I do a bunch of mentoring with young men. One young man came to me and he was like, they call me Mr. R up here. They're like, Mr. R, Tesla. Buy into Tesla. I'm about to get a Tesla car. And I'm like, Tesla? I don't know how Tesla is going to do. I don't trust Tesla. But he's like, get it. I'm telling you, it's going to be it. The youngest mindset, as you said, look at Tesla now. If I had invested back 4 years ago and listened to that one voice that I didn't give respect to, as you stated there, I would have made so much money. I listen to everyone now.
Yep. I don't look at the credentials behind the name anymore. I want to understand why you're telling me to look at this company, and then I'll go from there. I mean, it's very interesting. Right? I mean, Luke, my oldest child is 10, and I remember when he was doing his little portfolio recently, and he said, "All right, he wants us to." This is at the start of COVID. He wants to buy Dell, he wants to buy Microsoft, and I asked him, I was like, okay, why are you buying Dell? He said, well, we all know going to the school from home and every single student got a Dell computer at school. And I'm assuming all the other schools in our area, in our county got Dell computers. Well, how many schools across Florida got Dell? How many schools across the United States got Dell computers? I want to buy Dell. I was like, okay, this is a 10-year-old talking, right? I mean, at the time he's 8.
Smart.
And then I said, why Microsoft? He's like, well, every computer, when you boot it up, it uses this thing called Microsoft Windows. And so I want to make sure that we buy Microsoft because it's on every computer that they gave us. And he's like, and by the way, Daddy, don't you have a Microsoft Xbox? And we're going to be home more. I think more people are going to be playing their Xbox. I'm like, hats off to this kid. This little kid is talking about why he's buying this stuff. And it made sense. And sometimes we overlook simple things like that and we disregard the person that's talking to us about it.
You're totally right. They're the ones who know what the next brand new thing is, right?
Roblox.
Like in technology and anything, right? Roblox. And
Yeah,
look how big Roblox is.
And we bought Roblox the day it came out. He was the one. But I told him, both he and his brother said, you need to come back and explain to me, what is Roblox? You have to tell me how Roblox makes money. Those are the two things. What is Roblox and how it makes money? And they came back, 3 days later and they stood up and did a little presentation to me about Roblox. And I was like, wow. He's like, yeah, well, if all the kids at school are talking about Roblox and the parents buy, right, Robux, imagine that they're nagging us, right? They're going to be nagging their parents and it's only open to this group of kids now and it's going to scale internationally. Made sense. So don't disregard the information that they get from people just because of who you think they are, what their backgrounds are.
Love it.
I love it. And it kind of comes back to just getting that outside perspective again, right? Because everyone has different experiences and different ways of looking at things. And it's super important to in your evaluation of everything that you're doing in life, just be at least open to asking why.
Information is not a bad thing to have. Take in information and process it.
Love it. And then to move forward a little bit, I mean, your kid went through the whole platform model. He was like, okay, I've got the hardware, I've got this operating system on the hardware.
Yep.
Only thing he needed to buy was AT&T, and he'd have the whole internet like stacked. Yeah. But tell us, David, on the topic, where do you see technology playing a role in the future of the world of finance and how money works today?
Well, we've seen what's happened with fintech, right? It's made it so much easier for people to get into the market and invest. And I think technology is going to make it easier for people to get access to private equity investments, right? Access is the biggest issue that we've had. The public markets are good, but most money is actually made before the company does the IPO. Right? Let's be very frank. The only person guaranteed to make money on the day of an IPO is the person selling stock or who own pre-IPO stock. So how do we get more of the general public to own pre-IPO stocks? I think technology is going to solve that problem. It's working on it now. That's going to be solved without question. The second thing is moving money around internationally, right? For you to be able to invest elsewhere or move cash back and forth. Yes, we had back in the days of these wires that we have to send these international wires and they pay crazy fees, or you do money transfer and you pay these big fees. The technology completely changes that and reduces the cost of doing that. So that's going to be a big change. But the last one that I think a lot of us have not really thought about enough is how technology changes business travel, right? You think about how much money companies used to spend on meetings and traveling around the world. And of course, COVID changed that, which means technology changed that. Zoom that we're on right now changed that. That's a whole lot of money that companies are going to save. That means they have more money to hire people, more money to invest in R&D, more money for marketing, more money to go straight to the bottom line, which becomes dividends for investors. So I think technology is about to transform what we call SG&A, right? Selling general and administrative costs for companies in a way that is bad for airlines, but is good for owners of businesses. There's more money that can go into the business itself rather than going into getting people to meet face to face and sometimes not even be productive.
You know, I want to tap on that for a second, because there's something really interesting about how, like, I'm seeing that being the way that information is moving, right? So that was what the internet originally did, was I can send an email, I can send messages, and I can have valuable information that's in it now that can reach another part of the world, you know, through time and space, right, at an instant pace. So thinking about now how obviously we're talking about capital itself, right, moving at a much more efficient, faster pace, accelerating the movement of capital is huge in its own. And then we're going back now to even people themselves and everything that they have, the relationships that they bring with them, right, is something that is also starting to just move even further into this online format. I think that's a super interesting insight.
Yep.
What do you, real quick, I wanted to ask you, as we're about to move into our last segment, you know, with the economy and the way it is, inflation at a high rate, you know, multiple incidents happening around the world that are affecting the economy. What can you say to a young investor or investor of old who's in this now, who feels like maybe it's not a good time to continue investing or even start? What do you say to them regarding investing?
This too shall pass. Right? If you just look at history, this is just a blip on the radar. Right? Economies survive. You know, they're very resilient. Capital wants to find a home and get a return. So don't focus on the short term. Don't focus on the last 6 months. Right? If we have survived 2 world wars and then seen massive growth come out of that, most companies that we've seen exist today and are big were somehow founded during wars. They were founded during the worst times, the Great Depression and so on. So don't look at this as a bad time to invest. Look at this as an opportune time to invest, right? Prices are down, which means that there are things that are cheap. There are companies that are undervalued. Will they still be around in 10 years and 20 years? Are they domiciled in strong long-term growth industries? That's what you need to be thinking. Think long-term, especially if you're young. If you're 20, 30, man, you don't have to worry about the next 5 years. You need to be thinking the next 20 years, what this looks like.
I love it. Thank you so much for that.
Fabyan, is it time?
It's time.
It's time.
Time. Wrapping around. How y'all feeling?
Feeling good. So, David, at the very end of these episodes, we do a rapid round where we're going to ask you a few questions real quick. Just want to get the first thing that comes to your mind. And this is a no judgment zone. So don't worry.
All right. I'm ready.
All right. So tell us, David, what is money?
What is money? Money is ability to influence things and people.
Who inspires you the most, either dead or alive?
Michael Lee Chin.
Tell us a little bit about why he inspires you so much.
Because he's willing to share so much about his journey and how he has created wealth, and he gives back. He has given back significantly from a charitable standpoint.
I love it. And then tell us, what is your favorite book that you've ever read?
My favorite book is actually Cash Flow Quadrant, the sequel to Rich Dad Poor Dad.
And that's Robert Kiyosaki, correct?
Robert Kiyosaki.
Cool. And
I
then
love that. That's the first time we had that book come up. Good stuff.
Yep. Tell us, do you have a podcast that you listen to that you would consider your favorite podcast?
All right, so it is a judgment-free zone, right? So I need to. I'm trying to remember if it's the exact name, but it's Secrets of Millionaire Woman. I think it was done by Wall Street Journal.
Interesting. Very interesting.
Women manage money differently. So it was fascinating to hear about them.
That is awesome. I'm about to look that up, but I know that, a close second is right here. Man, look, David, you've been great. You've provided so much information for our viewers as well as ourselves. I think you educated both Keith and I in so many ways you don't even understand. But at this time, we want to probably give you 30 seconds or less to promote yourself. Let people know what you have coming up in the coming weeks, months, days, whatever. Let people know what they can look out for you.
No, well, I'm excited. David Mullings. You can find me on Twitter at David Mullings. You can go to bluemahocapital.com. Maho is MAHOE. Capital.com. You can learn more about what we're doing. And if you just Google David Mullings, you can see my appearance on Bloomberg. I think you'll learn quite a bit from there, and you'll see podcasts like this and others that I've appeared at. But excited, we're working on allowing people for the first time to get access to investing in the Caribbean through an offering that we expect to have qualified soon, and we can't wait to give people a way to impact lives in a positive way, right? We're talking about impact investing, not just getting a return on capital. We also want to get a return on people. Looking forward to that.
So am I. Thank you.
Okay.
Keith.
Yep. And then lastly, just want to say thank you to all of our viewers, listeners, wherever you are in the world. We appreciate you. This has been another episode of Cash Rules.
And if it ain't about the money, don't be calling me up. Hey. Thank you so much, y'all.